So let's go down this path, because this is the path that gets very political very quickly. Okay?
Mm-hmm.
100% agree with everything you said, which is painful for me to admit where people can hear me say it.
Gotcha.
But it's true. I would also point out that the Fed has taken this data dependency stance since day one. We're going to be extremely data dependent. We're going to be extremely communicative. We're going to let you guys know how we feel about things and what's happening. But there was always hesitation baked in. They didn't want a 1970s hyperinflation. They didn't want a 1980s double dip recession. So walking this close into an election in November 5th, with the turmoil of now Trump being shot, with Kamala Harris being named the front runner as a candidate, which frankly, let's be honest here, if she would not have been the front runner, there's $250 million in the campaign pool that would have been effectively lost if not utilized. So there was an economic reason to prop her up as a potential presidential candidate. But now all this turmoil is going on. The last thing you want to do as a Fed is feed into this. So they needed something big to happen. They could point to you and say, hey, we're data dependent, but look at this massive ass market correction. Look what just happened. We're not cutting rates because of the president. We're cutting rates because this tangibly happened in the market. And I don't think this will be the only one before September. I think there'll be more coming, frankly. So what this gave the Fed was this one massive piece of data to look back and rely on, that they could point the finger at and say, hey, look, maybe we acted too early. Maybe we acted too late. There's a lot of rhetoric on both sides of the equation there. But you know what? We can tell you unequivocally it had nothing to do with the election because this event happened. Now, there's some interesting and compelling reasons why them doing that, a rate cut, which, by the way, going into Monday morning, there was a 122% probability of a rate cut in September. For those of you who don't remember world interest rate probability in Bloomberg, which we covered on a previous show, that effectively means guaranteed 25 basis points and a 22% probability of maybe 50 basis points.
Which is crazy.
Which is crazy.
Because you would think that they would want to take a more gradual approach back down if they were truly able to achieve that soft landing scenario.
November now has almost 100% probability, still below it, even though it's widely consensus to believe that you won't see one then. You'll see a cut in December. And again, that's getting closer to 140% probability. But the interesting thing that was happening behind the scenes was there is still a 2-year, 10-year yield curve inversion. And just to be clear here, Haroon, if you could pull the note over there to the right a little bit more so I can see it. Thank you very much. All right, I'm gonna read exactly what I posted to social media on this because it got a lot of questions that I want to address on the show. This got little to no coverage today. This was Tuesday, the day after this all happened. But the movement in the bond market has been incredible. While the country was focused on the, quote, correction vernacular, most people missed that we briefly popped out of the yield curve inversion, the 2-year, 10-year inversion. So again, the 10-year Treasury is longer money. The 2-year Treasury is shorter money. If you buy a 2-year Treasury, it's a 2-year maturity. If you buy a 10-year, it's a 10-year maturity. Generally speaking, the farther out you go, the more expensive, the higher the rate is. In this particular market, because we're in a yield curve inversion, you actually get a higher rate on a 2-year because there's more confidence in what's going to happen in the next 2 years, and there's a lot of uncertainty in the next 10 years, so that is actually a lower rate. That, according to Bloomberg, wasn't supposed to get out of the yield curve inversion until Q1 of 2025.
Wow.
But throughout all of this controversy, the fact is the yield curve inversions have predicted recessions with near certainty. Out of the last 6 recessions since 1980, 5 were predicted by an inversion, okay, of at least 20 days. The 6th in 2020 was the COVID-era pandemic, which in my mind was a government-fabricated or created recessionary economy. So I look at that as a statistical outlier that really shouldn't be considered in traditional data, but whatever. It was an unprecedented event.
Right.
All right. So the COVID was heralded as a 6-day-long inversion, whatever, it doesn't really matter. Here's what you need to know. We got out of the inversion on Tuesday briefly.
Yeah.
That's how much wide flux you had in the 10-year and the 2-year.
Right.
Which meant that the 10-year dropped and then rose, and the 2-year dropped, right? And it dropped a whole hell of a lot more than the 10-year rose.
Right.
And what happened is you got this brief period of time where you came out of the inversion. Now you're starting to see that come out. This typically precedes recessionary economies. These are huge warning signs of a recession. And guess what? It went right back to being inverted again.
Oh, wow.
So this movement in the bond market was spectacular for a lot of reasons. And I didn't think it got enough coverage on television, most notably because all you saw when you went to social media, the non-traditional media outlets, was, oh my God, mortgage rates are going to fall, because the 10-year dipped a little bit.
Yep.
And as a result of that, mortgage rates did drop a little bit.
Mm-hmm. I mean, some lenders were out there quoting high fives, man.
Yeah, which to me was wild.
Yeah.
And look, you can do that. More power to people who got the rates. And I think you're going to see some action in the markets as a response to all this. But here's the problem. Now you've seen a small correction in the stock market. Great. Good. It's overvalued. There should be more correction to come. And I think you will see more correction in the stock market.
Okay.
What the catalyst will be kind of uncertain right now. But look, let's be honest. If the Nikkei has a correction, if London has a correction, you can expect to see the fallout in the United States. That's clear.
Okay. So to Chris's point earlier, when we were talking about these rate cut predictions, okay, the Bloomberg World Interest Rate Probability, that's one that we've relied on the show, and the Chicago Mercantile Exchange, right? CME watch tool, right? Yeah. As of right now, there's a 72% chance at a 50 basis point rate cut in September, right? That's currently, and a 28% chance at a 25 basis point rate cut. Something else that we've routinely talked about on the show, every 3 meetings or so, right? Every 3 months, the Fed releases what they call a summary of economic projections, right? Where they see how this all plays out with their rate cuts. The first one that got released earlier this year in March, they had predicted 3 rate cuts by the end of the year. This last one that came out, they revised that down to only 1 rate cut. Now, based on the Chicago Mercantile Exchange, I haven't checked Bloomberg's World Interest Rate Probability, but based on the Chicago Mercantile Exchange, they're baking in 3 rate cuts. So September, November, December. That's acting very quickly. If they do that, that means there's real problems ahead. Because
the market's afraid of another correction like this.
Oh, yeah.
The stock market's freaking out. Let me be clear. I don't think you're going to get 3 cuts like that unless something big happens. I think you're still going to see 1 in September, pause, 1 in December. That's what I think is the overwhelming probability of reality. But the stock market, the same people who predict this stuff, the economists who predict it, are freaking the hell out right now. They're going, shit, man. We have another correction like this, you're talking full-on recession.
Here's the problem, though, for all these people that are freaking out, right? A lot of this is based on what's going on in the market, okay? And unfortunately for them, there's also been a lot of positive data, too.
Oh, yeah.
You had the GDP print that came out, I mean, growing at a significant pace, like over 2%.
Yep.
Right? But you're still hearing rhetoric of like a rate cut before the next meeting.
Let me tell you the difference. You want to know what the difference is?
Yes.
This shit affects their pocketbook.
Yeah, exactly. That's why everyone's talking about it.
When everybody's pocketbook gets kicked right in the ding-ding, everyone starts to go, holy shit, wait a minute. I think there's a problem here. We should cut rates.
Yeah. So just for everyone to know, the Fed can act whenever they want. There can be an emergency rate cut if something collapses. Okay, and I have a list here of the times where it has happened in recent history. Okay, so they'll usually do this and pull this trigger to prevent some type of market crash. But one of the last ones that happened was after the tech bubble burst in January of 2001. That was a 50 basis point rate cut. Okay, I mean, obviously that was very significant. That was a huge market crash, right? April of 2001, a weakening economy. They caught another 50 basis point cut, right? Same year. After 9/11, the terrorist attacks, 50 basis point cut. But look how significant these events were in order for them to do an emergency rate cut. I mean, these are all stuff that have been embedded in our minds. August of 2007, Fed cuts rates 50 basis points because of the housing market crash due to subprime mortgages. Right? We all remember that, right? The great financial crisis. January 2008, the Fed cut 75 basis points because of the stock market crash that followed the great financial crisis, right?
Notice there's always a bigger cut after stock market action than there is anywhere else.
Yes.
Yeah.
Yes. And then you got October 2008 when Lehman Brothers failed, right? The financial system was in all sorts of disarray. And March of 2020 when they slashed rates completely and they cut it by 50 basis points.
So let me tell you simply why. This is just human behavioral economics, okay? You can log into your 401k. You can log into Fidelity. You can log into E-Trade or whatever your accounts are, Raymond James, pick something, right? You can see the value of your stock in dollars right then and there. And you know for certain that's what it's trading at that day.
Yep.
right? If I sold it today, that's what it's worth. Your home values aren't the same thing. And that's the other problem here, okay? If inflation, 30% of inflation is housing,
Right.
right? If 40% of core inflation is shelter and housing, right? And they cut rates, the realtor's like, oh my God, value's gonna go up, value's gonna go up, value's gonna go up. No, they are not.
Mm-hmm.
Let's dispel that bullshit from social media right now.
Okay.
Let's just end the rhetoric here. You saw the 10-year, 2-year move in the way that we just described. Went down, popped back up, and it went from inverted to not inverted to back to inverted in a single day, in a matter of hours.
These things do not move that quickly. They're not supposed to anyways.
They're not supposed to. They do every once in a while, but again, in a matter of hours, okay? The mortgage market popped up. Everybody and their mother's getting mortgages. Oh my God, mortgage rates fell. Those mortgage rates are dropping in anticipation where people think that 10 years is going to go, because here's what happens. Before a rate cut, people in financial institutions go, ha, ha, ha. We know there's going to be a rate cut coming. We think this is going to go down this way. So they're essentially betting that mortgage rates are going to drop and these rates are going to be attractive in the market later on. Because most people who originate loans are going to sell them in the secondary market. They're not going to keep them on their portfolio. Banks keep stuff in their portfolio, on their books, right?
Mm-hmm.
Lenders, who generally drive the low price in the markets, will sell them into the market. Well, guess what? If they're wrong and they're originating, like you said, in the high 5% and mortgage rates go up to 6.5%, 7%,
Yeah.
those mortgages are not as valuable as new mortgages originated today at a higher rate.
They're going to have to hold them on their books.
Or take the economic loss.
Yeah.
Depends on if they have money coming in or not. If that's on a line of credit, then you have to pay it back. You have to sell it.
Yeah.
You have to take an economic loss. If you're a bank and you hold it, you don't care as long as somebody's paying you back. You're making less money than you could, but it's all good. It's arbitrage.
Right.
That's all really important, because here's what's going to happen, okay? And I've been calling this since day one. I'm just going to tell you unilaterally this is how it's going to happen, because I think people are just really under false pretenses here. Don't listen to social media realtors, okay? There's no economics course required for real estate, okay? If a realtor's been seasoned and they're good and you know them and they have expertise and they watch the news and they're really ingratiated in the economy, great. That's on you. But by far and away, the biggest mistake I see people make is relying on realtors for financial information, okay? Even some of the greatest real estate economists out there are so unbelievably fucking biased. Logan from Housing Wire is a great example. I love Logan, but man, is he biased towards the home builders.
Mm-hmm.
Okay, he just is. And I get it. You're in the industry. That's how you stay, abreast of what you do, and it's important for you that you have a spin and you have a narrative. Fine. Mortgage rates are not going to fall dramatically, because if they do, it's going to ignite the housing market and drive inflation right the hell back up. The worst thing for any of us is if housing values go up. Because guess what? It's a lagging indicator, and it's going to drive inflation back up. And guess what? You're going to have more rate increases, not more rate cuts. The last thing we want as a society is to push people in to buying homes right now and to drive values up. That would be incredibly fucking dumb.
Right.
And just to show you how stupid it is and yet how prevalent, Saied, I've got a present for you.